In finance, we have this obsession with precision. We build these incredibly intricate models, all chasing one single objective number that's supposed to tell us exactly what a company is worth. But what if I told you that this entire temple of modern valuation is actually built on the oldest human art form there is? Storytelling. This quote just nails it, doesn't it? A great valuation can't just be about the numbers, but it can't be a complete fantasy either. It has to be a bridge built with the hard steel of today's data, stretching out toward the hazy horizon of a future we can only imagine. And that's the big question, isn't it? Where does the comfort of our calculations stop and the courage of our convictions take over? Finding the answer to that really gets to the heart of what investing is all about. This leads us to the great valuation paradox. We crave the certainty of a calculator, right? We want that one single correct number. But the paradox is that this entire mathematical structure is built on a foundation of pure imagination. It's a story we tell ourselves about a future that hasn't happened yet. You know, there's actually a name for this craving for certainty. It's called physics envy. It's this deep desire to find a simple, elegant formula for a messy, complicated human world. But here's the thing. A company isn't a particle in a vacuum. It's a complex, living system. And when you try to force it into a neat little equation, you often end up hiding the very thing that drives its value, its story. So let's do it. Let's pull back the curtain on the most revered tool in the entire valuation toolkit, the discounted cash flow model, or the DCF. We're going to look at it, but not as a calculator. We're going to see it as a storytelling machine, a device that forces us to translate our beliefs about a company's future into cold, hard numbers. So simply put, a DCF model tries to figure out what a company is worth today by estimating all the cash it's going to generate in the future and then, discounting that value back to the present. It's basically a way of translating a vision for tomorrow into a single number for today. But, and this is a huge but, every DCF model has this fatal weakness, perfectly summed up by that old programmer saying, garbage in, garbage out. The model's final number is incredibly sensitive to your inputs. You just tweak a single assumption about future growth, even a tiny bit, and the final valuation can swing by millions, even billions. It means all that precision is a dangerous illusion if the story you're feeding it is flawed. Now, this is where things get really interesting. The real story, inside the model. It's not in all those detailed year-by-year forecasts. Nope. It's hidden in just two highly subjective assumptions about the distant future, and their impact is just massive. 80%. Just look at that number. In a typical valuation model, this much of a company's calculated worth, it comes from a single guess, a single piece of storytelling. So what on earth could this be? What single assumption is so powerful that it accounts for the vast majority of a company's perceived value? Well, the answer kind of pulls the curtain back on this whole idea of pure objectivity. And here it is. Up to 80% of a company's value often comes from something called the terminal value. It's a single number that represents all the cash a company will supposedly generate from year 10 until the end of time. Yeah, forever. Let that sink in. The vast majority of our precise, calculated value is basically a guess about infinity. This table here is like a translator. It takes the math and turns it back into a story. Your projected cash flow, that's the story of the company today. How's it doing right now? The discount rate, that's just a number that captures how much the market believes in your story and how risky it all seems. And the terminal growth rate, that all-powerful number, that is the story of the company's ultimate destiny. Tesla is the ultimate case study for this. I mean, if you tell a story of Tesla as just a car company, your DCF model will probably tell you the stock is wildly overvalued. But if you tell a different story, a story of Tesla as a dominant AI and robotics company of the future, you use completely different assumptions, and suddenly the valuation can make perfect sense. Same company, two different stories, two wildly different numbers. Now, of course, this power of narrative has a dark side. When a really compelling story becomes completely detached from the underlying fundamentals of the business, it can lead to delusion, to speculation, and to massive financial bubbles. And this is where our own minds can betray us. You've got confirmation bias, where we hunt for data that fits the story we've already fallen in love with. There's familiarity bias, which makes us choose comfortable stories over maybe better but less known ones. And then there's herding, That's just the fear of being left behind, forcing us to adopt the crowd story even when it makes no logical sense. This is how bubbles get going. It starts with a powerful new narrative. Prices go up, which seems to prove the story is true. So more people pile in, pushing the price even higher. And soon enough, the actual fundamentals are just ignored. The story and the price feed each other in this dangerous upward spiral. So all this brings us to a much more refined way to think about this. The best investors don't see valuation as some math problem. They see it as a high-level strategic art, practiced by people who are both master storytellers and, at the same time, their own toughest critics. I mean, think about Warren Buffett and Charlie Munger. Their first question isn't what are the cash flows, it's what's the story. They look for simple businesses with what they call a durable economic moat, a sustainable competitive advantage that protects the company for the long haul. The story always comes first, the numbers come second. So what is the ultimate purpose of a great business story? Well, it's to prove one thing, that the company can generate a return on its capital that is consistently higher than the cost of that capital. Think of it this way. For every dollar you plant in the business, you harvest more than a dollar back, year after year. That simple, powerful narrative is the only thing that truly justifies a high valuation in the long run. So maybe we've been asking the wrong question all along. The final number from a valuation model isn't the answer. It's the question. It is the beginning of an argument, a disciplined debate with the future. The spreadsheet doesn't give you truth. It simply provides the language you need to tell your story and the courage to see if it comes true.